If you've been paying attention to what's been going on in the news for the last few weeks, you know by now that Silicon Valley Bank and Republic Bank failed a couple of weeks ago. So, with all that said and people running and trying to get all their money out of the bank accounts because the world is in a panic, is this the right time to buy a business? Well, stay tuned because in today's video, we're going to talk about that and my thoughts. So, let's get to it. What's up, everybody? Welcome to my channel. I am your host, Leo Landaverde, business broker and commercial lender, helping you buy and scale a profitable business. If you are a small business owner looking to increase your wealth by buying a profitable business, or if you are an employee or a W-2 employee trying to leave the rat race behind by becoming the CEO of your own company, you're in the right place. Please subscribe to my channel. Don't forget to hit the bell and you'll be notified every Thursday when a new video comes out. So we're going to talk about, in this video, basically two parts to it. So in the first section, we're going to talk about the truth about the failure of Silicon Valley Bank and Republic Bank and why that matters or doesn't matter to you. And also the next part, we're going to talk about SBA lenders, what they're doing about it and how that concerns you. So with that, let's go into the truth about Silicon Valley Bank and what happened. So, So it really comes down to three things. I gotta say at the outset that this is technically not a surprise. A lot of people saw it coming. Now that I have some time to digest, the signs were there. And here it comes down to really three things that happened that are isolated to this bank and is not really a generalized thing on the bigger banks. So one, it was sort of a perfect storm for this particular bank. Was the rollback on the federal stress or the Trump era regulations. So and number two was the management, the actual management of the bank had a role to play. And third, inflation and interest rates. So let's dissect that. So back in 2015, the chief executive for Silicon Valley Bank, Greg Becker, went before Congress to argue that the stress test that had been put on from the post the 2008 recession, the whole meltdown that happened, many years ago, actually 15 years ago, wasn't necessary for Silicon Valley Bank. That they didn't really, the bank didn't pose a threat to the banking system in the event of a collapse because it was a small regional bank. And at that time, they have $40 billion worth of assets. The threshold was $50 billion. So they said, we don't need it. And so there were some of those rollbacks that happened because of that, sort of ease off some of those regulations, which, now eventually was sort of the beginning of the undoing for Silicon Valley Bank. That was in 2015. Now, in 2022, the bank did not have a chief credit officer for some part of 2022. It's like, the equivalent of driving a car without a driver. So who is actually minding, the stop signs and their lack of gas or they're off? Nobody was really minding, and that's critical because there were some things that happened, the credit decisions that were made. So, which leads to the next thing, which is the inflation and interest rates. Now, for over a decade, most banks have enjoyed a decade of zero money. I mean, there was cheap interest rates. The interest rates didn't start really climbing until really like 2021. But for a long time, basically it was zero. The banks basically got it at zero and they put it to work and it was very good for everybody. And banks paid billions and billions of dollars. But, so in particular, Silicon Valley Bank, they were actually getting all this tech capital. They were the go-to bank for private equity or VCs, venture capitalists and private equity. They were deployed all these billions of dollars, basically also cheap, zero interest. And the bank got greedy and they started putting all those monies in long-term treasury bonds. But as the interest rates crept up, they started to have some losses. So they divested of some of those assets at a loss. So that triggered with the ease back on the stress test and that was sort of the perfect storm. And the lack of management, that's what led the bank to collapse. Now, some of the bigger banks, they actually have those very highly scrutinized stress tests that they really are too big to fail. The bigger banks, the Citibanks, the Wells Fargo, the BofAs, the Chase, they have that higher scrutiny because they cannot really afford. We cannot have another 2008 crisis. So So that's that. But guess what happens? People act on emotion, right? Not everybody is cool-headed and rational. So I'm in California, and Silicon Valley Bank is just 200 miles away from us, and I know of people, first degree from me, that actually had depositories, and they have businesses, and they have payroll. They were worried about it, and President Biden came to the news and said, "Hey, look, this is going to be fine because we're going to honor over anything over the $250,000 threshold that the FDIC insured," and we're back to business. Now the stocks have since rebounded, and we're good to go. You need help buying a business? If you do, I'm here to help. People come to me every week. I respond within 24 hours. You can either send me an email. My email address is in the description section of this video, or you can just drop a comment below. Either way, I'm here to connect with you and help you in your journey to buying a profitable business. But fear remains, because if you're not well informed, if you don't stand for something, you're gonna fall for everything. If you really don't have that knowledge overall of what's going on, then you're gonna find that this is the time to run for the hills. The world is ending, and that's when you gotta be cool, level-headed. So, to my next point, are SBA lenders still lending? And I'm happy to tell you that yes, SBA lenders are still lending. There are plenty of deals. Banks are hungry. They are want to. And here's the main reason, and this is why you should feel confident, is because the SBA, it's not a bank. It's an insurance company. It's a guarantor. There is a pool of money. Every borrower actually contributes to that pool to the tune of, 1.5 to 3.25% of the actual loan is set aside on a pool whenever, in case there's a fail of any actually SBA loan. So with that said, the loans are guaranteed. So the SBA guarantees the loans up to 75% on, or up to $3.75 million maximum guarantee on the loans, which means that the bank will be made whole. The corresponding lender that does an SBA loan will be covered up to 75% of the total loan amount given to you, which lowers the risk profile. It's a win for the bank. The bank puts the money at risk. It's a cash flow loan. The SBA, so long as the bank did their job, they're going to cover that. And if you did your job right, you're going to buy a business that is not going to go under. So the SBA will be still lending. The SBA lenders are still lending. And here's the thing that you need to understand. Lenders will not walk away from a perfectly sound investment. This is what they do. This is what their credit risk managers, this is what their underwriters, everybody's trained to look for the deals. Now, a lot of you subscribers, they come to me and they're always very concerned, like, why would I personally guarantee a loan? And why is the SBA lender, like, as if the SBA lenders are the bad guys? The reality is that they're there looking out for you, making sure that you're making a sound investment. Wouldn't it be great to have somebody that has more experience in looking at deals help you buy a deal? And you know what? They're going to upfront you up to 90% of the deal, perhaps by even with some of the work, giving you additional for working capital. It's not uncommon to do that. And if you don't believe in the deal and you're not willing to put 10% down, why would the bank give you 90% of the deal? So, okay, so lenders will always finance great businesses for sale if three things. The debt service coverage ratio is great, and I probably talk about the debt service coverage ratio every day of the week in different scenarios: working capital loans, buying, acquisition type loans. So if the debt service coverage ratio, if you bring a deal to me that makes sense, that the debt service coverage ratio is 1.5 to 1 or even 2, plenty of cash flow even after servicing the debt, and you are a good buyer with good credit, good management experience, good down payment, at least 10% of the deal, and you're willing to invest so much that, hey, I'm going to partner up with the SBA lender. I'm going to put 10%, they're going to put 90%, and you're okay with personally guaranteed, which, as I said before, why wouldn't you? You cannot do a deal with a bank without personal guarantee anyway. So if you don't want to do that, then you're probably in the wrong channel. And you probably should be looking at some other videos where you can actually buy money with no money down and no guarantees, and you can walk away anytime and all the recourse that you want. That would be the wrong channel. I am here to help you if you want to actually finance a deal through a bank loan. So debt service coverage ratio, you're a good buyer, and this is a sound business in an industry that makes sense, then Absolutely, you will get a business loan, an SBA loan to buy your business every day of the week. Hopefully that helps you guys. Thank you so much for tuning in. If you need my help, I'm here to help you out. Thank you so much for watching. For a limited time, I'm giving away my cash flow calculator that as of today has been downloaded hundreds of times, helping business buyers like yourself analyze any deal from the internet or from anywhere, looking at the cash flow, looking at what the loan would look like and what the post-debt service cash would be and exactly how much you would be having as cash flow if you were to buy a business. Great tool. All you have to do is click on the link below and it's yours to keep for subscribing to my channel. Thank you so much.